Welcome to our lecture video. In this lecture, we are going to study several important capital budgeting decision rules: IRR, MIRR, payback, discounted payback, and the profitability index. Our goal is not just to memorize definitions. Our goal is to understand what each rule tells us, why managers use it, and where it can become misleading. In capital budgeting, the central question is simple: does this project increase the value of the firm? That is why net present value, or NPV, is the benchmark rule. NPV measures value creation in today's dollars. If a project has a positive NPV, the present value of the expected future benefits is greater than the present value of the costs required to undertake the project. For an independent project, the NPV rule is straightforward: accept positive NPV projects and reject negative NPV projects. But managers often want more than a dollar value. They may want a percentage return, a measure of how quickly the investment is recovered, or a way to compare value created per dollar invested. That is where IRR, MIRR, payback, discounted payback, and profitability index become useful. However, remember this important principle: a rule can be convenient without being reliable in every situation. So throughout this lecture, we will ask 3 questions for each method. What does it measure? Why is it useful? And what does it leave out? By the end, you should be able to use these decision rules intelligently, compare them carefully, and understand why NPV remains the main benchmark for value maximizing decisions. Let's begin with the internal rate of return, or IRR. The IRR is the discount rate that makes a project break even in present value terms. In other words, it is the rate at which the project's NPV becomes zero. You can think of IRR as the project's break-even return. For a conventional investment project, the cash flow pattern is simple. There is an initial cash outflow, followed by future cash inflows. In that setting, the IRR rule is usually easy to apply. If the IRR is greater than the required return, the project is expected to create value. If the IRR is less than the required return, the project is expected to destroy value. If the IRR is exactly equal to the required return, the project is expected to break even in present value terms. This is why managers often like IRR. It summarizes the project as a percentage return, and managers are very comfortable thinking in percentages. Interest rates, loan rates, hurdle rates, margins, growth rates, and investment returns are all commonly discussed as percentages. So when someone says, "This project earns a return above our hurdle rate," that message is easy to understand. IRR is especially useful when the project is conventional, independent, and has a normal cash flow pattern. In many such cases, IRR and NPV will lead to the same accept or reject decision. But here is the key insight: IRR and NPV answer different questions. NPV asks, how much value does the project create today? IRR asks, what discount rate makes the project break even? Both questions are useful, but they are not the same question, and that difference becomes very important when projects are more complicated. Now, let's discuss the problems with IRR. IRR is intuitive, but it can be misleading in several important situations. The first problem occurs with non-conventional cash flows. A conventional project usually has one initial outflow followed by inflows, but some projects have cash flows that change direction more than once. For instance, a project may require an initial investment, then generate inflows, and later require a large cleanup cost, legal settlement, environmental obligation, decommissioning cost, or major reinvestment. When cash flows switch signs more than once, the project may have more than one IRR. That means there may be more than one break-even discount rate. In that case, the phrase, "the IRR," becomes confusing because there is no single answer that can guide the decision. A second problem is that some cash flow patterns may produce no meaningful IRR at all. The IRR rule cannot help if there is no economically useful rate that makes NPV equal zero. but NPV can still be calculated at the required return. A third problem is scale. IRR is a percentage, not a dollar value. A small project may have a very high percentage return, but create less total value than a larger project with a lower percentage return. A fourth problem is timing. Some projects generate cash flows earlier, while others generate them later. Because discounting affects later cash flows more strongly, project rankings can change when the discount rate changes. Finally, IRR is sometimes interpreted as if interim cash flows can be reinvested at the IRR itself. That assumption could be unrealistic, especially when the IRR is very high. So the lesson is clear. IRR is useful, but it should not be used blindly. When IRR conflicts with NPV, we must investigate the reason for the conflict. To address some of the practical weaknesses of IRR, we use the Modified Internal Rate of Return, or MIRR. MIRR is designed to make the return calculation more realistic. The ordinary IRR combines several assumptions into one rate. MIRR separates two important issues: the cost of financing negative cash flows and the rate earned on reinvested positive cash flows. The general idea is shown in the background formula, but let me explain the intuition without walking through the equation. First, negative cash flows are brought back to the beginning of the project using a finance rate. This finance rate represents the cost of funds, or the appropriate rate for project outflows. Second, positive cash flows are moved forward to the end of the project using a reinvestment rate. This reinvestment rate is often based on the firm's opportunity cost of capital or project required return. Third, MIRR finds the single rate that connects the present value of the negative cash flows with the future value of the positive cash flows. This is powerful because MIRR makes the reinvestment assumption explicit. Instead of implying that interim cash flows are reinvested at an unusually high project return, MIRR allows us to use a more realistic reinvestment rate. MIRR also generally produces a single rate for a project, which makes it easier to interpret when cash flows are unusual. So MIRR has several advantages. It is easier to communicate an NPV when managers want a percentage return. It reduces some of the confusion caused by multiple IRRs, and it gives a clearer reinvestment assumption. But MIRR is still not a replacement for NPV. MIRR remains a rate of return. It does not measure the total dollar value created by the project. When projects are mutually exclusive and the objective is value maximization, NPV remains the preferred rule. Next, let's talk about the payback period. The payback period answers a very simple question. How long does it take to recover the initial investment? This is a liquidity question. It focuses on how quickly the project returns the cash invested in it. To calculate payback, we track the project's cash inflows over time and determine when the cumulative cash flows recover the initial outflow. When cash flows are uneven, the calculation identifies the last full period before recovery, and then estimates the remaining fraction needed to complete recovery. The payback rule is usually based on a management-specified cutoff. A firm may say that a project must recover its initial cost within a certain acceptable period. If it does, the project passes the payback screen. If it does not, the project fails the screen. Managers like payback because it is simple. It is easy to explain, easy to calculate, and easy to communicate. Payback also focuses attention on exposure. A project that recovers cash quickly may be less vulnerable to long-run forecasting errors, competitive changes, inflation uncertainty, regulation changes, or technological obsolescence. This can matter a lot in industries where the future changes quickly. But payback has serious limitations. First, ordinary payback ignores the time value of money. It treats cash received sooner and cash received later as if they have the same value. Second, payback ignores cash flows after the cutoff date. A project may create substantial value after the payback period, but the payback rule does not recognize that value. Third, the cutoff is often arbitrary. It may be based on managerial preference rather than economic value. And fourth, payback does not measure value creation. Therefore, payback should be used as a secondary screen, not as the primary capital budgeting rule. Discounted payback improves on ordinary payback by incorporating the time value of money. Ordinary payback asks, how long does it take to recover the investment using actual expected cash flows? Discounted payback asks a more disciplined question. How long does it take to recover the investment in present value terms? The difference is important. With discounted payback, each future cash flow is discounted before we add it to the recovery calculation. The discount rate reflects the opportunity cost of capital and the risk of the project. This means discounted payback recognizes that cash received in the future is worth less than cash received today. As a result, discounted payback is more financially sound than ordinary payback. A project that appears to recover quickly under ordinary payback may take longer to recover once the future cash flows are discounted. This makes discounted payback useful when managers care about liquidity but also want to respect the cost of capital. However, discounted payback still has an important weakness. It ignores cash flows after the discounted payback cutoff. That means a project could fail the discounted payback test even though it creates significant value later in its life. The rule may reject long-term projects that are valuable but slow to recover their initial investment in present value terms. So, discounted payback is better than ordinary payback, but it's still incomplete. It tells us something useful about recovery time and risk exposure, but it doesn't measure total value created. The main lesson is this: discounted payback is a useful supporting tool. It can help managers evaluate liquidity and downside exposure, but it should not replace NPV when the objective is to maximize firm value. Now let's turn to the Profitability Index, often called PI. The Profitability Index measures value created per dollar invested. Instead of asking only how much value a project creates, PI asks how efficiently the project uses investment capital. The formula is shown on the screen, so let's focus on the meaning. For a conventional project, PI compares the present value of future cash inflows to the initial investment. A profitability index above its break-even level indicates that the project creates value. A profitability index below its break-even level indicates that the project destroys value. At the break-even level, the project has an NPV of 0. PI can be very useful when capital is limited. Imagine a firm has more attractive projects than it can fund. In that case, managers may want to know which projects generate the most present value per dollar invested. PI provides a capital efficiency measure. This is especially helpful under capital rationing, where the firm must choose a set of projects within a limited budget. But PI has an important limitation. It is a ratio, and because it is a ratio, it can favor smaller projects that create less total dollar value. A project may look very efficient per dollar invested, but still add less total value than a larger project. This is similar to the scale problem with IRR. When projects are independent and capital is limited, PI can provide helpful information. But when projects are mutually exclusive and the firm can fund the best project, NPV should dominate PI. So remember, PI tells us about value per dollar invested. NPV tells us about total value created. Those are related, but they are not the same. At this point, let's compare the decision rules as a group. Each rule emphasizes a different aspect of the investment decision. NPV measures dollar value created today. Its greatest strength is that it connects directly to firm value. Its main challenge is that it requires estimates of cash flows and an appropriate discount rate. IRR measures a percentage break-even return. Its greatest appeal is that it is easy to compare with a hurdle rate. Its main weakness is that it can misrank projects or produce confusing results when cash flows are unusual. MIRR measures a percentage return with an explicit reinvestment assumption. It is often more realistic than ordinary IRR, especially when reinvestment assumptions matter. but it is still not a dollar measure of value. Payback measures the time required to recover the investment. It is simple and useful as a liquidity screen, but it ignores the time value of money and ignores later cash flows. Discounted payback also measures recovery time, but in present value terms. It improves on payback by adding discounting, but it still ignores cash flows after the cutoff. Profitability index measures present value per dollar invested. It can be useful when capital is constrained, but like IRR, it is a ratio and can favor smaller projects. So these rules are not equally reliable. NPV is the best measure when the goal is unconstrained value maximization. The other rules are best understood as supporting tools. They help managers think about communication, liquidity, capital efficiency, timing, and sensitivity to assumptions. A good financial manager does not ask, which rule do I like best? A good financial manager asks, what question am I trying to answer? And which rule answers that question correctly? Now, let's discuss when the alternative rules are useful. We should not dismiss IRR, MIRR, payback, discounted payback, or profitability index. They are popular because they help managers ask practical questions. IRR is useful when managers want to communicate project performance relative to a hurdle rate. It is especially natural for conventional projects with one initial outflow followed by future inflows. MIRR is useful when managers want a percentage return but prefer a more realistic reinvestment assumption. It can also be helpful when ordinary IRR is difficult to interpret because of unusual cash flow patterns. Payback is useful as a liquidity or risk exposure screen. In fast-changing industries, managers may care deeply about how quickly cash is recovered, because distant cash flows may be highly uncertain. Discounted payback is useful when managers want the liquidity focus of payback, but also want to account for the opportunity cost of capital. It adds financial discipline to the recovery period question. Profitability index is useful when the firm has a limited capital budget and wants to compare value created per dollar invested. It can be a helpful starting point for capital rationing analysis. But there is a very important warning. These rules should be used as diagnostics, not as substitutes for economic reasoning. If a project looks attractive under several rules, it deserves careful attention. If the rules give conflicting signals, that is not a reason to choose the most convenient answer. It is a reason to investigate. Why are the signals different? Is it because of scale, timing, cash flow pattern, reinvestment assumptions, capital constraints? The deeper lesson is that decision rules are tools. They help structure our thinking, but they do not replace judgment. Let's close by returning to the most important idea in this lecture. NPV remains the preferred rule for value maximization. There are four main reasons. First, NPV measures value in dollars. A percentage return cannot tell us the total amount of value created today. NPV can. Second, NPV uses the opportunity cost of capital directly. Future expected cash flows are discounted at a required return appropriate for the project's risk. This allows the project to be compared with alternative investments. Third, NPV is additive. The value of a portfolio of independent projects can be understood by combining the values of the individual projects after considering interactions. This property is essential for building a capital budget. Fourth, NPV handles unusual cash flows more reliably. Even when IRR is multiple, missing, or difficult to interpret, NPV can still be calculated using the appropriate discount rate. So, how should we use the other rules? Use IRR to communicate percentage returns. Use MIRR when reinvestment assumptions matter. Use payback to think about liquidity and exposure. Use discounted payback to add time value discipline to the recovery question. Use profitability index to think about value per dollar invested, especially when capital is limited. But interpret all of them relative to NPV. The final question is always, does the project increase the value of the firm? That is the heart of capital budgeting. Thank you for watching. I hope this lecture helped you understand IRR, MIRR, payback, discounted payback, and profitability index more clearly. I look forward to seeing you in the next video.